Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
A very good evening to all the people who joined into this broadcast. My guest this Friday is Mr. Sunil Singhania, a man I'm sure one and all of you is familiar with and needs no introduction, but I will do the formality nonetheless. He is obviously most famously known for being the Chief Investment Officer at Reliance Mutual Fund, what is now Nippon India Mutual Fund, and then of course was elevated for a more global role looking at other asset classes in Reliance Capital. He's currently the founder of Abakkus Asset Management for the last 2 years. He's had a splendid and a very long career behind him, educationally as well as professionally. He's an All India ranker as a CA. He's cleared CFA in all his three first attempts. He's very actively involved with the CFA Society. He's also served on various non-profits. He's also been part of the ethics board of the CFA to draft many regulations. In fact, was one of the first CFAs in the country. In addition to that, he also holds a lot of interest in sports. He's also been the president of the Goregaon Sports Club, if I'm not mistaken. So a man of varied interests and a man with a stellar track record. Sunil, good to be speaking with you. A very good evening to you. Thank you so much for taking time out to do this. And good to be speaking with you in this avatar after almost 10 or 11 years.
Thanks a lot for having me and thanks for all the good words. It's a pleasure to be here.
So I just wanted to first start off by getting a sense that everything at your end is safe, everyone's healthy, work, office, family, everything is good.
No, Upar wale ki kripa hai, all well.
Awesome. So Sunil, I want to start with your journey in capital markets and take you right back to your childhood days. Talk to us a little bit about how this journey started. If I'm not mistaken, I read somewhere that your first trade you actually made a profit of 10,000. And you used to read a lot of balance sheets that your father used to get. So talk to us a little bit about how your journey began, what piqued your interest, and how did the stock market begin to define your career objectives?
So, right from my college days, frankly, or I would say from my school days, I was very clear that I didn't want a career on the medicine or the engineering side. So when I was in school, the only careers in India were either you become an engineer or a doctor or you become a chartered accountant. So either you take commerce as a subject or science. And I obviously took commerce because I was not interested in the other two. And while I was in college, obviously, equity market started to interest me. It was early days, mid 80s. And since then, balance sheets and accounts and finance and numbers, being a Marwadi, obviously there's a natural affinity to numbers. That obviously, always interested me. And I became CA at a very young age. I was only 20 when I became a chartered accountant. And, in CA, you have to do articleship. So right from my age 17, I was going to office doing articleship, and at that point of time my interest in balance sheets and numbers only grew. And immediately after I finished my chartered accountant, I started to practice, definitely. But as I said, I was during college days, I had small sums of money and used to apply for IPOs. That time it was a big thing, late 80s, and that's how the first sort of tirade with investing and making some money began. And obviously the big kicker, even while I was practicing, was the big boom which the equity markets in India had from that infamous Harshad Mehta time. I think that brought a lot of, I would say, fresh, professionals into the equity markets. It was the start of a cult. And then it only got strengthened when the first phase of reforms under the finance ministership of Manmohan Singh began. And you had the country open up, foreign investors started investing in India, NSE was formed, and that basically made me shift full time into equity markets somewhere in 1994.
I read somewhere that your first trip out of Bombay was an audit to Gwalior for State Bank of India. Is that correct? What was that
Yeah,
experience
and
like?
as I said, I became a CA at the very young age of 20. I had to wait for my CA membership because 21 was the minimum age where you could become a CA and have a certificate of practice. So immediately after that, I was a young chartered accountant. I was working with my uncle, as a partner, and then I started applying for all the government audits, and we got allotted 3 branches of State Bank of India. I think Bhopal, Gwalior, and Tarapur. And I took the Punjab mail, I remember, and went to Gwalior. It was like 26, 27 hours journey. First time I had gone out on an official visit alone. There was no mobile, nothing. I remember I wrote a letter when I reached to my family that I've reached, and that letter reached when I came back to Mumbai. After I came back, it was good learning times, and Gwalior that time was very notorious for chambal, and you still had those little bit of aftermath of the dacoits there. But it was fun.
So you did see guns firsthand when you were in Gwalior.
I saw a gun shop for the first time in my life, and that was really shocking. And I remember that the audit was in a place called Shivpuri, which is away from Gwalior, which again is a smaller place. And there, the hotel where we were staying in, right outside the hotel, you had a gun shop, and that was like for someone going from Mumbai just to see a gun shop was very, I would say, shocking.
As long as you didn't hear gunshots, you were okay.
I was lucky.
So Sunil, you also had a stint in your formative years on the sell side, and then of course you moved on to the buy side. Tell us a little bit about those formative years on the sell side and what prompted you to make the shift to buy side. At what point in fact did you decide?
So as I said, when the country opened up in 1994, NSE was coming up as a new exchange.
Mhm.
And I had a friend whose relatives wanted to take the membership of the National Stock Exchange. And they needed someone to write the exams. So, that's how they got hold of me, that this is a guy who can pass all the exams. So they made me a director. I passed the exams, and then they offered me to run the business. So that was my first, I would say, stint of becoming a broker. And despite being first stint, I think we did very well, because what I did was a lot of Bombay Stock Exchange brokers did not take up the NSE membership, because I thought that, unless you meet physically, how can you do a trade?
Hmm.
And when the NSE started doing very well, I went ahead and tied up with all the Bombay Stock Exchange brokers who did not have NSE membership. So we did very, very well. In 1997, I came across this nice gentleman called Pashupati Advani, and I wanted to move from a retail broking kind of a stuff to institutional broking. And that's how I became a director in his company, was heading the institutional sales and research side, set up the research desk there. And we're doing pretty well. But the equity markets between 1999, 2000 was a dot-com and a IT boom. But other than that, till 2003, we had one of the worst recessions in the world after 9/11 hit the US.
Mm-hmm.
And at that point of time, stocks used to trade at like 2p, 3p. And on the sell side, I used to just keep on pushing the stocks, but no one used to even listen to us. And at that time, I said, it's better to buy on your own rather than make anyone buy. And in 2003, almost all the mutual funds were my clients, but I was besotted by the word Reliance. And, I used to service Madhu and Amitabh Junjunwala and the rest. And, I just happened to tell them, and I was hired without even a formal CV. So in my life, I haven't made a CV except for purpose of putting it on LinkedIn, frankly.
So I'm going to come to your Reliance days in just a bit, but there are two questions that popped into my mind as you were answering the previous question. When you started doing research in an era, like you said, there were no mobile phones, there was no digital platforms, information was probably not that easily accessible. How do you see research having changed, say from the mid 90s to where we are in 2020? How has the process changed? Has it got better, or do you feel there's a lot more noise and the substance has gone down and it will probably be a lot more in-depth then? Talk to us a little bit, since you straddled almost 25-30 years of this experience of research.
So one is, research per se was not, I would say, very common. There were various reasons why stocks used to move up and down. Also, at that point of time, we had results coming in once in 6 months, and that also after a gap of 2 months. We had balance sheets which were filed in paper format with the Bombay Stock Exchange. So unless you had equity stake or shareholding, you would not get a balance sheet. And the only way to get a balance sheet was go to the Bombay Stock Exchange, write a letter, and then they would charge you some 50 paisa, 1 rupee per page, and take out a photocopy of the balance sheet and give. Companies did not have websites. In fact, internet was not present at that point of time. It was just coming up. And therefore, the availability of information was very limited. Access to management was the privilege of very few. And therefore it was tough. But I would say that at the same time, because not too many people were doing research, I think reading balance sheets was advantageous. Because you could read balance sheets, and at that point of time balance sheets had a lot more information. Now I don't know why, but slowly the company law board has done away with a lot of information like quantitative details and all. But that time you could do that. At the same time, I would say research has evolved now. One is there are many more people who understand research and who intend to do research. In fact, Twitter is full of them, and I would say there is an overload of research. Companies are more forthcoming in meeting. Websites are available. There is a lot of data available online. You can, compare companies across the world. The trends of product prices, raw material prices, a lot of other things are available online. At that point of time, to find out what the aluminum prices were internationally, you would have had to know someone. And then you had to maybe dial an international call to find out the price. So a lot of inefficiencies have got converted into efficiency. But at the same time, I find that because there is an overload of information, people are becoming short-term rather than becoming long-term. Because you know so much on a daily basis or a minute-on-minute basis, people have started, I would say, responding instantaneously. And the other thing is that everyone has the same information at the same time, and therefore everyone wants to react in the same direction at the same time. And that's why the volatility in the markets have increased dramatically. So oil falling to zero and then back to $40 can only happen in this kind of an era, because there are so many people wanting to react in the same direction at the same time. I think it's good that it's become more transparent, but at the same time, it's led to overreactions also.
Do you still read annual reports?
Almost all, whatever I can lay my hands on. And the good thing is that now all annual reports are on a soft copy basis. So frankly, a lot of my spare time over weekends goes in reading annual reports. So I try to read almost 1,200 to 1,500 annual reports. Nowadays, what I've tended to do is all the large cap annual reports I tend to skip, because there's not too much to look at it. So I go and read the management discussions there and go through the financials. But I do try to read 1,200 to 1,500 annual reports every year.
That's very interesting to know. And I hope my analysts are listening to that too. You said that there was a time where you were trying to push stocks which were 2 and 3p and there were no buyers. How do you react today when the whole world is chasing stocks that are 40, 50p, and you still find people ascribing target multiples of 60p to justify buys? I mean, you must think that you're walking upside down in a totally different era altogether.
So see, Rahul, I think PE is not the only indicator to determine the value of a stock very clearly, but it's a good indicator. So we cannot say that a PE of a stock is high, so the stock is a sell, and the PE is low, the stock is a buy. But it is a good indicator. Also, one has to realize that PE is based on reported earnings, and there's a difference between a company generating profits and showing profits. There's a big difference, and I think that we have to be very clear, and that comes to know when we read balance sheets and do our groundwork very, very well. At the same time, I don't understand this concept of buying at any price, frankly. So I buy a shirt for 2,000 rupees. Maybe if it's a Armani shirt, I will pay 4,000 rupees. If it's a Hugo Boss, I might pay 5,000 rupees. If it's some other brand, I might pay 8,000 rupees. But to say that, okay, now a Armani shirt is available at 20, I will buy, then at 40, I will buy, then at 60, I will buy, and at 80, I will buy, just because it is quality, do you buy at any price? And I think that is where the disconnect is. So even when you are looking at stocks, I think we are now reaching a stage where some of the stocks growing at 10% are trading at 70, 80p. And I always have this thing in mind, so if you have, say, unlimited money, and if a company comes and says that buy 100% of a company, will you buy the company at a profit the company is generating? If the answer is yes, then you should buy a stock. So if a company is making 1,000 crore profit, and if you're willing to buy the whole company at 80,000 crores, then you should buy the stock. You should not buy the stock in the hope that someone else will come and buy it higher from you. And I think the good thing about this market is that because of this lopsided nature, we get opportunities. So last 6-8 months, people were just ignoring anything to do other than the top 30, 40, 50 companies. And it was a great time. We launched our second fund somewhere in August last year. We had this concept called 15, 15, 15, which was 15% growth, 15% ROE, but less than 15 times. And it was very difficult to sell, because the only stocks which were performing were stocks which were over 60 and 80p. Right. But the good thing is that because of the discipline, we were able to build a position, and now only those stocks are moving up 2, 3, 4 times because people are seeing the value. A 80p stock cannot become a 400p stock. A 5p stock can become a 15p stock. And I'm again reiterating, P is not the only thing, but it's a good indicator because it is determining the value or at what price the stock is discounting compared to its earnings. I think there are various other matrices, but just because you say that this is quality, you go and buy at any price, that is some disconnect. And I wrote a piece last year, which was widely read, which was Bubble in Quality, and which was widely criticized also. But everyone has a right to have a view. And my perspective is you should follow in investing what you understand. You should not try to copy that. Today I become Warren Buffett and tomorrow I become some hedge fund manager who's going to buy only the Teslas and the Netflix of the world, and the third day I become something else. I think we should invest in something which we have confidence in and which we understand.
That's fair, and a point well made and well taken. Let's go back to the start of Reliance. I believe, even though you said you never made a resume, your interview did not even last 15 minutes.
I think out of that 15 minutes, maybe 7-8 minutes we were discussing more than else. But I think the good thing is that I was always interacting with them even before I joined. So there was some I would say, familiarity in that sense. So it helped. And I think that was the DNA of Reliance. It was a very entrepreneur kind of an organization. And, I think it was great working with Madhu for so long.
2,400 crores was the AUM when you joined. And if I'm not mistaken, 2.4 lakh crores was the AUM when you left. That's 140.
So actually, 2,400 crores had 2,300 crores in fixed income from Reliance Industries. We had only 50 crores in equity.
100 crores of equity, which when you left was about 70,000 crores plus.
Yeah, around 75,000 crores. The AUM of the mutual fund was 2,75,000 crores. And along with the advisory mandate, we were almost 4 lakh crores. But, one thing I'd like to add here. I and Madhu joined around the same time, around 2002 and 3. And one thing which I believed in that time and which I continue to believe now is that India grows because of entrepreneurs and despite the government. And that is the kind of segment which we invested in that point of time. So I already had a list of companies which I was pitching, but no one was buying. And here, despite having a small sum, at least we were able to buy what we were pitching. And the 2003 to 2008 was a great period. US currency was depreciating. There was a big boom in economic activity globally and even in India. And our segment of the company, which were entrepreneur driven, grew much faster. So within 5 years from being the smallest out of 35 AMCs, we became the largest out of 35 AMCs. And I think Harvard did some 3-4 case studies on us. So it was great.
No, it has. I mean, I think you were awarded the Lipper Award in 2006 for the best fund for a 5 and a 10-year period. And I think Reliance growth over a 20-year period had, I think, a 22-23% CAGR.
Yeah, it was the first fund, I think, I don't know, maybe the only fund which grew 100x in 21 years.
Yeah, and I think one of the first to hit an NAV of 600 somewhere in May of 2014, if I'm not mistaken.
Yeah, actually, we hit a NAV of 1,000 in 2017.
Wow. But I think somewhere around May 14, it was somewhere around 600, if I remember.
Yeah, maybe. Yeah. But we were the first to hit a NAV of 1,000, which was 100x.
What are your memories? I mean, this is a remarkable journey. Obviously, price appreciation had played its role, but just the fact that it's gone up 100x.
So I'll tell you, Rahul, I think one thing is that, as I said, it was a very entrepreneur-driven organization. We had zero intervention with the management or the shareholders. We launched a very innovative funds at that point of time. See, the good thing about Reliance Mutual Fund was none of us had any background of managing mutual fund money. I, Madhu were all from the sales side. Even the team which we formed predominantly was from the sales side of analysts and all. So we had a very clear and uncluttered and no history and no baggage. And I think that worked very, very well for us. The other thing is it was also very nice because we were doing things which were little offbeat, So when all the other funds were looking at MNCs and trying to figure out we were trying to figure out who the passionate entrepreneurs are, who can grow 3, 4, 5x, and the memories of companies like Divi's and Jindal Steel and Power and the Kirloskar Group and so many other companies which we identified, on the engineering side and all. Though I think very, very satisfying. See, it is good to make money in a stock, but it is not as exciting if there are 30, 40 others who also have invested in the stock. The thrill is that you have a stock which no one else has. And, there is maybe not acceptance of that stock. And when that stock does well, I think you really, really feel so good about it. So imagine Divi is starting from where it is and today coming in Nifty in a great journey. And, I think collectively as a team, we did a lot of hard work.
I'll probably pick up a couple of these names as case studies as we go along. But, apart from being entrepreneurial in its culture, as you mentioned about Reliance Mutual Fund, what were maybe the 2 or 3 things as processes that you put in place there that aided this magnificent growth, while Madhu and you were at the helm? And what were a couple of things that the institution or the organization taught you, which you have carried forward with you in life and that will stay with you?
So one is, as I said, we had an open mind, so we were not cluttered. Second is, frankly, when we were running mutual fund, there were hardly any brokers who were servicing us because we were so small. They used to not even pick up our phones. The sell side guys, and we remember who was not picking up. But one good thing is that, as I said, we were never stopped from doing what we wanted to do. So as a firm, we were the first to come out with sector funds. So we had 4 sector funds. After the IT sector fund which came out, no one had the courage to launch sector fund, but we came out with a banking fund which did very well, power sector fund which at one point of time was the largest fund, a media fund and a pharma fund. The pharma fund continues to do very, very well. There's a very great fund manager in Sailesh there. So that was one innovation. And then, we hired one of the largest teams in terms of research analysts. So that time the trend was that mutual funds used to work with 2-3 people because, they used to all rely on external research. Our call was do as much research as we can in-house. So we had one of the largest teams, and because we had no constraint from the management that you have to focus on profitability on, we were able to do it. Third is we were, again, as I said, open, so we were the first in India to get MSCI BARA to help us in our risk assessment. So unlike the perception that Reliance Mutual Fund was a trading kind of a fund house, actually we had one of the best processes. And in fact, because we had to prove ourselves so hard, we worked on a lot of these processes also very hard. I remember even now one of the largest multinational bank took 2 years to complete our due diligence before they started selling our funds. And I used to always jokingly tell the head of that private bank that because they've been so rigorous, we saved 4-5 crore rupees. Otherwise, we would have had to hire a McKinsey or an EY to set our processes right. So they were, I would say, great things. At the same time, I think one thing which was a learning which continues to be now, that the largest money comes in at the peak of the market. And how do you manage that is very, very important. It is very easy to show performance on a 50 crore, 100 crore fund, but how to manage institutional money is something which is very important. And I think a lot of these learnings we have carried forward at Abakkus. So the first thing which I did when I formed Abakkus was to ensure that we had a large team. So today with such a small AUM, I have almost 11 people on the investment side, almost 9 analysts. And we, frankly, at this point of time, we can do even with 2-3, and that is saving to us because it's my own balance sheet now and my own P&L. But very consciously, we are growing, we are creating an organization which lasts from a longer point of time. A lot of things which we used to do that. So even in Reliance, even at that point of time, we used to track global trends, like which sectors are moving globally, what is happening globally. I, because of my CFA connection, also used to travel a lot. And that also helped. And even now we do that. So I think that really helped. And one thing which, and I think all my colleagues would vouch for is that we had great relationship across the board. So whether it was the smallest of smallest brokers, the smallest of smallest analysts, salesperson, corporates, whether they were small, large, and I would say that has helped me tremendously. So when I set up Abakkus, almost immediately 30-35 brokers without having greed of getting any commission in return started servicing us. Even now we are small, but I think relationships and the old connects pay. I've never had any issue with corporates not wanting to meet us despite we being very small. So I think if you are modest and if you realize that, the world is round, today you are small, tomorrow you are big, but your relations have to be the same. I think that I would say is a great non-sort of investment related learning, And I would urge all the young professionals to follow that. Don't let success go to your head.
Well, I could easily plug in our firm's tagline over here, which says it's a relationship beyond broking.
100%. 100%.
But no, I take your point, Sunil, because I remember how supportive you were of us. I think we were probably one of the last institutional broking houses to set up in India at the start. And I remember how supportive you were in our early days and even through the journey. So from being in an organization that was allowing you to be entrepreneurial in nature to now being an entrepreneur yourself, what has changed? And what prompted you to take this?
Actually, frankly, it's been a very smooth journey. I was a little apprehensive because all my life I have never turned an entrepreneur. And the reason I turned entrepreneur was, one day I was sitting and just thinking about my future, and I said to myself, I have maybe 15 years of professional life ahead of me. I wanted to do investments. That was very clear because that is my love. And I said that, I have all along been of the view that entrepreneurs run India, and I am myself chickening out becoming an entrepreneur. And that is the time I decided to turn an entrepreneur. Obviously, it took me a year to convince my bosses to let me leave. But when I set Abakkus, for the first 3-4 months, obviously it went into setting up the office and setting up all the things. One is I got really good people to work with me from the start. So Biharilal Devada joined me from day one. My earlier colleagues, Aman Chavan and Archan, who were working with me at one point of time in Reliance, they joined me. And then I don't know, but maybe we would have done some good work in the past. I just put a small comment on LinkedIn that we're looking at analysts, and we had like 400-500 resumes, and we hired 4-5 out of them. So it went off pretty well. We were lucky to get a good office in the capital, and friend architect did it really well. So I would say that it was pretty decent. And the moment we start, again, I would here like to thank specifically IIFL and HDFC Bank, because they were the two primary partners for us in the first one. And then, I would say that now all of the other ones are helping us, ICICI Bank in particular, and some of the other ones. And they were able to raise, we raised one of the largest, corpuses for the first fund launch. So the first fund we raised almost 1,350 crores, which was $200 million. It was one of the largest fundraisers for an IF in a very difficult time. If you remember, 2018 was not a great period to raise money, particularly after the crash in the mid and small cap side. So it worked out well. We broke even also pretty fast. So, the investment which I had to put in to begin with, I put in. But after that, it's been a sort of a self-sustaining kind of an operation. And as I said, we have great people. We actually had not lost even a single person till the COVID happened. So one person left because she wants to start a family, and the other person did not want to come back to Mumbai from where he was staying. But other than that, the same team is working, and I think it's been a great journey. And I would say that we are now all set to be relevant. And here I would like to share that when I joined Reliance, we had 50 crores, and it took us maybe 2 years to get to 1,000 crores. I think that way, in 2 years in Abakkus, we are already 2,500 crores. So we are trending much faster than what we were in Reliance.
No, for sure. I think both you and Kenneth actually moved on from very successful careers at your fund and have managed to do very well for yourselves. In fact, Kenneth was the guest that preceded you on this show, and we were discussing some very similar thoughts on his transition from IDFC to Old Bridge as well. I want to pick up on a few names that you have taken. I'm not, we as a policy, we don't discuss stocks on this show, but I like to reference certain case studies that you have done in the past that have worked out well for you. And you have mentioned Divi's a few times. You've also mentioned, and I've read somewhere that you were one of the early investors into iShares and Bajaj Finance as well. And all of these, of course, are very, some of them first generation entrepreneurs, or even if they were not first generation entrepreneurs, run very well by, maybe second or third generations. What drew you to these companies? What was the initial phase like? And then did you sell them off at any stage and look back and say, oops, I shouldn't have?
So one is very clearly, this was a group effort. So, I should not alone take the credit of all the names you mentioned. It was the team which did it. But I'll just specifically, on the second part of the oops, so the two of my biggest regrets have been selling off Bajaj Finance and Eicher Motor early. Okay. And I'll give you a perspective. Bajaj Finance, the first time we looked at, and I did personally a lot of work on it, was somewhere after the Lehman Brothers crisis. The company had a market cap of, I think, 400-500 crores, and it had a price to book of maybe 0.2, 0.3, I don't know. And no one was looking at Bajaj Finance because the only thing that it did was finance the Bajaj scooters And that time I would say very unpleasant, I would say, is that Bajaj scooters had very poor resale value. So the moment you bought a Bajaj scooter, it became second hand. It had very poor resale value. So if you had borrowed money against it and if you did not pay, the NBFC, which was Bajaj Finance, used to take a big loss, and that was what was happening. But I think what happened was there was a change in management. Rajiv Jain had just joined, and luckily it was such a neglected stock that no one used to meet Rajiv Jain other than me. And we invested at one point of time. We had like 8-9% in the company. But वो बोलते हैं ना, पैसा बहुत जल्दी बन गया. And at that point of time, post Lehman, to make 3-4x of your investment was like a dream. And we sold it off, maybe 3-4x, and we were out of the company. And then it became 100x from that level. Similarly, in Eicher Motor, we bought, I think, almost 10% of the company just after Lehman is a block. And in a short period of time, we were like able to exit everything from 2 times to 4 times. Very, very short, like 1-2 years. And as I said, it was one of the biggest regrets because I would say the focus at that point of time was these were companies which were making you money in a very, very tough time. And frankly, we did not visualize that both these companies could keep on growing at 40% for the next 10 years. But I think there is always a lesson in everything. So the way you regret buying a stock which makes losses for you, I think you should also introspect and study stocks which you have sold and then which go on to be significant higher than where you sold off. Obviously, no one is God that you would buy at the lowest price and sell at the highest price. But introspection is always good because it ensures that you don't repeat the mistakes. So, there is a clear sort of a thought process that you're allowed to make a new mistake every day. But you can't repeat mistakes. To keep on inventing new mistakes, there's no problem.
So, of these 3 names, Sunil, while sitting in 2020, while the street is still divided on Eicher, there are Bajaj Finance and Divi's is still pretty much a consensus buy. So how do you, sort of react when a sell-side broker comes to you and says you should be buying Eicher or Bajaj Finance today at, this price to book value or this valuation, given that you've seen it a decade back at those prices? What is your mindset when you look at the company 10 years hence?
So I will give you a perspective. I don't want to comment on these specific names, but I will just give you a answer which will relate to it.
Sure.
2003-4, we used to look at companies where the possibility of the net profit in future was equivalent to the current market cap. So suppose if you bought Jindal Steel and Power at 400 crores market cap, our view was that in 5 years, the profit can be 400 crores. That was a thought process.
Okay.
Why I'm saying this is that whenever you buy a company, irrespective of the valuation, I think you have to keep in mind, one, what it is discounting, and second, the possibility of it. So say if someone comes and makes a point that, say for example, motor cars, passenger vehicles on the 4-wheeler side. So if the largest company again is X percentage of market, and if you expect that company to grow at 20% for the next 10 years, then how many cars that company would sell? And for that company to sell that many cars, how many number of cars totally in India will have to be sold? And if you think that is a possibility, then only the derivation is possible. Similar is the case in financials. So if you believe that, some company can keep on growing at 35-40% for 10 years, one, we have to realize that if a company grows at 40%, in 2 years it doubles. In 10 years, it will be 2:5. It will not be 20 times, it will be 2:5. 2:5 will be 32 times. So whether that possibility exists. So once you are very clear about it, then you know that this is not possible or this is possible, and then you can take a call accordingly. So then you know that I'm playing this only for the next 2-3 years, not for the next 10-20 years. And our report on bubble and quality was exactly that. So I'll tell you in a very simplistic manner. When you invest in equity, are you investing to make 5%? I don't think anyone in India is investing in equity to make 5%. The expectation will be at least 10-12%, right?
Absolutely.
So if you expect 12% returns from a stock and that stock is growing at 10% year after year, that means every year your P multiple will have to go up by 2% to generate 12%. So 10% return will come from growth and 2% from P expansions. So if a company is already trading at 80p, over the next 10 years, if you have to make 12% return from that company, after 10 years, the PE of the company will have to be 110 or 120. Is that possible? Is that happened anywhere in the world? If it has not happened anywhere in the world, then it will be maybe a 20 sigma event, not even a 6 or 8 sigma event for that to happen in India. Sometimes, you take those calls, you might go wrong in the near term, so anyone who bet against quality, we have gone wrong over the last 3-4 years. Maybe they might go wrong again over the next 2-3 years, who knows? But you are very clear that this cannot happen from a 10, 20, 30 years perspective. So a lot of these examples which you give, you have to try and see what the price is building in.
How do you deal with periods of underperformance, Sunil? And I want to reference 3 specific examples here. One is, like you said, Reliance had a very big pharma fund. Before this huge rally that we saw multiple years of underperformance and under ownership for various reasons, US FDA, recalls, etc. We saw that in Reliance Industries. The stock went to sleep for multiple years. We've seen this in Hindustan Unilever, where the stock went to sleep for many, many years. But in all 3 cases, when Lever broke out after a long period of consolidation, it gave many-fold returns. So did Reliance. And in the current process, pharmaceuticals is. But during that period when your patience is being tested, how do you reconcile to that fact?
So one is, it's frankly not easy. It is definitely stressful, and particularly when you are managing public money. See, when you are investing your own money, you're not answerable to anyone except yourself. But when you are investing public money, your investors want to know, your distributors want to know, and particularly when you are managing public money, the media also wants to know. And we are in this world where there is more joy from someone else's pain rather than pain from someone else's, So I think we are in this world where people will point fingers the moment you start to underperform. So it adds to the stress. But I think over the last 20-25 years of managing public money, you start to get a little bit mature. So on the sector funds, it is easier because anyway you are investing in the sector. In terms of your own funds, I think more than how to answer, you yourself have to introspect. And there are always times when, you will have those bouts. Now, suddenly pharma, as you said, has done well. So all the funds who had exposure to pharma have done well. And those who did not have are struggling. I would say the bottom line is don't give up and start creating positions just because the sector or the stocks have started to move. Because that would mean that you would make the second mistake of entering at the wrong time. So I think if you are very clear of what you are going to do, and if you are able to communicate to your investors very clearly what you're going to do, then some part of the stress will go off. So when we communicate 15, we're telling the investors that, I don't know what is going to happen over the next 3-6 months. If it works well in the near term, it's fine. But over this period of time, this is what we are expecting. That helps. But still, investors are investors. There will always be pressure. And I think somewhere you will have to keep on building it. From an investment in a particular stock is concerned, I think the largest time at least which we try to devote, is stocks which are not working, to understand why it is not working. And I think the best thing to do whenever we research a stock is we talk to the analyst who is the most bullish, and then we talk to the analyst who is the most bearish. And always, you will always get something which is a little bit different. And then, if you're able to reconcile that, it is fine. Ultimately, you will have to take some risk. Without risk, there is no return. So there will be no stock which will have no kintu parantu, so to say, or ifs and buts. There will always be that. And that is the reason there is a mispricing. So when we were buying, for example, I used to be always fond of gold finance companies, particularly the largest gold finance company. And we had in Reliance almost 5% stake in the company, and we continue to own it even in Abakkus. There's a lot of disconnect, cash ka dhanda hai, gold, this thing. So you have to work that much harder. And sometimes it does get frustrating. I remember Divi's fell. I was in New Zealand on a holiday, and Divi screwed up my holiday at that point of time. It fell from 1300 to 600 because for the first time in their life, they had a US FDA, notice which was issued to them. From that level, the stock is up 5 times, but it did cause a lot of stress because in the near term, your performance goes for a toss, and all said and done, you also have to manage the near term. But I think you slowly get used to it. You manage a portfolio which is diversified, and I think that is where diversification comes in. And as I said, you stick to what you understand and what you know. Don't try to copy others.
Interestingly, while you were making your point and you said somebody's misery is someone's pain, I was taken back to one of the lines from your favorite movie, 3 Idiots, where it says, "Jab dost fail hota hai to bura lagta hai. Jab dost first aata hai to aur bhi bura lagta hai."
Yeah, in fact, you should see a presentation which we had made 6-8 months back, where we had used Bollywood movie dialogues to give the state of the market, where we had done this. So anyway, related that China's pain is India's pleasure.
Interesting. Probably I will at some point. Sunil, when you became a CFA, I read there were only 15-20 CFAs in India, and incidentally you were on a trip somewhere where you realized that even Pakistan has a CFA society and India doesn't. Obviously, a lot of people write exams and they use the degrees to go on into their professional career. You chose to get into the organization itself in a very deep way. Why did you go so deep into CFA? What has it taught you? And what is your advice to people who are looking to do this as opposed to say an MBA or a CA?
So, when I was with Advani Share Brokers, I told you that the period between 2000 to 2003 was horrible.
Right.
And I had nothing to do, so I did CFA. One of my friends told me it's a great exam. So 99, 2000, 2001, I completed CFA. And as I said, during one of my exams, I had a very unpleasant experience, and I wrote to the CFA Institute that, you should be conducting the exams a little bit better. And they thought that let us involve this guy. And they invited me to the US, and, I graded papers, and that is where I came to know that Pakistan had a society and we did not. I think it's a great institution. It works on volunteerism. They have almost 150, 60 societies, all run by volunteers. And it's a great, great networking tool and a learning tool. I think that is how I got involved. I set up the India Society in 2004. I was a president for 8 years of the India Society. I then was nominated on one of the committees called Standard of Practice and Code of Ethics. I was among the 15 members who wrote the book, which you have to compulsorily pass to become a CFA. So 2 editions I was involved there. And then I got inducted as the first Indian on the Global Board of CFA Institute. So 2013 to 2019, I finished my 6-year term. And the last year, I was the chairman of the investment committee of CFA Institute, which gave me an exposure to investing globally. Because I was managing $500 million for free of CFA Institute money. But the networking, the learning you get, the course curriculum, it is very practical. So CA is a great course, but CA is more accounting and a little bit more theoretical. I think CFA opens up your practical sort of mindset, of how to look at various asset classes, global perspective. And I would say that for any investment professional, it's a good add-on. I don't think it can be the only designation because it's a self-study kind of a thing, but it can be a great add-on. And I'm also very involved with Nimish Bhai's University Flame. And it's always fun to interact with young professionals and students because, the current lot are the ones where you have to learn from. I am very sure if I would have been 15 years younger, I would have been more into the Facebook investing and the Tesla investing and Netflix investing rather than trying to buy a steel company or a cement company or, some company. So you learn a lot of new things from the youngsters. So that also sort of motivates me.
Interesting. I've seen a lot of people who are very passionate about it, Sunil. I think Navneet has given a lot of time to it.
Yeah.
I've seen, even Jayesh Bhai, who's recently
right. So we were all together in the society.
Yeah, I think we've tried to do our own little bit by trying to associate with the annual.
Great. Yeah, thanks a lot.
Into sports and the Goregaon Sports Club and cricket. Are you a sports person from your younger days? What took you down this route? Or is it just free time? Like you said, you wrote the CFA.
I think all of us in some way are sports people. All of us in Mumbai, at least, I'm born and brought up in Mumbai, have played gully cricket and tennis ball and rubber ball cricket and all.
And we all have an opinion on when Dhoni should retire.
No, but I think sportsman is a great, thing to be. Because it teaches you a lot of things. It teaches you to be competitive. It teaches you to be fit. It also teaches the value of team, and also the passion to win. And I think all that is useful in any kind of profession in life. So I think, I would say that this leadership kida comes from the start. I just forgot to mention, but I was a promoter director of Association of NSE Members of India. So I was one of the founder members of the Association of NSE Members of India, which is called the NBIE. And I think the association with Goregaon Sports Club obviously enabled me to make a lot of friends. Keep fit. I don't play cricket now because I have a little bit of a back issue, and I'm also old now. But it does help. And nowadays, there was a time when we in Reliance, we used to say, Hindi bolta hai promoter, ye acha kaam karega. Ye grassroots level ka hai. Ye kaam karne wala hai. Ye khali AC cabin mein baith ke baat karne wala nahi hai. I think I have realized that people who are in some way associated with sports, those promoters stand out. They will be fit. They will have a very different perspective. They will be very open to ideas. And I think that all helps in profession. So, and at some point of time, all these bits and pieces of different things impact different places of your brains, So you want the whole brain to be functioning, not only one part of it. And different parts of the brain have different likes and characteristics. So it helps.
Interestingly, you mentioned that you're growing old. I don't think so. I'll tell you a conversation I had just about 15-20 days back with a fund manager who was contemplating moving out on his own and said, "मैं नहीं कर पाऊंगा, मैं सुनील नहीं हूँ, वो भाग सकता, मैं नहीं भाग सकता." So I don't think you are perceived as being old by even your contemporaries in the mutual fund industry today. So my final question to you. A lot of industries, a lot of professions have opened up. We were discussing sport. India has moved way beyond cricket, and there's a lot of corporate money going into various sports. The digital economy has opened up, digital marketing, and there are various other careers that you didn't think were in existence 5 years back that are today. For a young person, starting their career, right, whether they're a CA, CFA, MBA, whatever, is equity research still something that you would recommend? Or do you think that the world is fast changing and somebody in their late teens or early 20s should look at some new generation professions?
So I would say that, for young, Indians or even globally, the good thing is that there is so much to do. As I said, when I was in school or college, we could either become an engineer or a doctor or a chartered accountant. There was nothing else. You know, arts में तो वो जाते थे जिसको यहाँ admission नहीं मिलता. If you actually think about it. Now there is so much to do. In fact, my son is not interested at all in finance. He is a geek. He did his MS from US. He's working with Amazon last 15 days on the software side. So you have to find your own passion and your own interest. Obviously, you should also have the capabilities. See, one thing we have to realize that all of us will have different capabilities. So we should not try to forcefully go into something where we don't have natural capability. Someone would be good in singing, someone in drawing, someone in sports, someone in finance. So we have to find that. But don't get bogged down by that, I want to be here or I want to be there. Research is a great profession, but unfortunately, I find research analysts wanting to become fund managers in 2 years' time or 3 years' time. I don't see any harm of being a research analyst for years. If you see in US, there are research analysts who have been research analysts for 30, 40 years because it's a specialized function. Yes, you have to have an ambition of becoming a fund manager, but spend some time in making mistakes. Then only you will be able to become a better fund manager. So I think you have a lot of opportunities. Even in the IT side, now you have a business analyst role. Almost in every organization, you have a business analyst role. It is similar to what you do here. Because ultimately, it is analysis of various kinds of data and things which come upon us. So sky is the limit. You can always experiment if you are young. So before 30, keep on experimenting. There's no harm about it.
I know when we started this, we had budgeted for about 40-45 minutes because you had another commitment. But it's been so fascinating listening to you that I sort of lost track on time. I just saw we're running close to 6.
I have a call at 6.
Yeah, I hope you enjoyed being on. It's been a pleasure listening to you, Sunil. It's
no, thanks a lot, and thanks a lot for making a hero out of me. But I still have 10-15 years ahead of me, and I'm like all the fellow investment professionals listening to it. And be passionate, be true to what you do, be honest, and think long term. Thank you.
Thank you so much, Sunil. Really appreciate your time today. Stay safe and hope to see you in person in the not too distant future. Thank you so much.
You.